My first post this week was about Weatherford's recent announcement of its shareholder return program. During its 2Q earnings call, Weatherford talked about a new authorization to pay a dividend and to start buying back shares of its own stock. These are things that Weatherford's larger peers, SLB, Halliburton, Baker Hughes, have been doing for years. Weatherford is not. They restructured, came out of bankruptcy at the end of 2019, and have been playing pretty conservatively financially, frankly, as they should, trying to build up this new business, chart this new path forward. And what I wrote about was that it's interesting that A, they're just now creating a program that their larger peers already have, but B, the timing of this announcement is particularly interesting. It really goes to show the obstacles, the challenges that exist in oilfield services today, that rather than using this capital to pursue attractive growth avenues, Weatherford has decided now is a time to turn around and hand this capital back over to shareholders in the form of dividends and share repurchases. So again, it tells us a bit about where oilfield services is today. I also wrote about how on the dividend side of the equation, Weatherford is now coming up with the lightest dividend package of these four. But on the share repurchases, they're more aggressive than all of them except Halliburton. That in itself is pretty interesting. So that's what I wrote about in my first post this week. My second post this week was about what I'd written about in the first post. When I talked about Weatherford's dividends, I used a metric, dividends over revenue. And it's not a metric that's often used when we discuss shareholder returns. In that second post, I wrote about why this is a unique metric, why we often, much more often, focus on free cash flow and the fraction of free cash flow that's distributed to shareholders. I wrote in the post about why I care about dividends divided by revenue because it incorporates more of the cash flow generation cycle, tells us a little bit more about how effectively these businesses are creating cash from the revenue that they book and then turning around and handing some fraction of that cash over to shareholders. So my second post was more of a corporate finance 101. Why are we using this relatively unheard of metric when there's more common metrics out there? I wrote about the importance of understanding what questions we're trying to ask, and as a result, what tools are we going to use to try to find answers to those questions. My third post this week was a recommendation of a podcast episode from Catalyst. Catalyst is a podcast hosted by Shayle Kann. The episode was all about geologic hydrogen, which is sometimes called white hydrogen. It's hydrogen that's buried under the surface of the earth, and there's a lot of sort of obvious parallels that you might imagine to oil and gas. So the podcast interview was with the CEO of a company called Coloma that's pretty heavily involved in this emerging geologic hydrogen space. And he talked about the importance of tamping expectations down here. It can be very exciting to think about all the possibilities that exist by trying to harvest hydrogen from under the earth, not having to manufacture it at the surface, which is a very energy intensive process and very economically challenged at the moment. You can bypass a lot of that by finding hydrogen that's already created and is already stored for you under the earth. There are other challenges, of course. He walked through many of those challenges and why it's going to take some time to even figure out what really is going to happen on this geologic hydrogen front. Where are these plays going to be found? How economical are they? How large are they? A lot to still be learned, but a fascinating conversation. If you're interested in hydrogen and or if you're interested in oil and gas, I definitely recommend you checking out. It's the August 23rd episode of Catalyst. Each weekend, I send out a free weekly newsletter that I call Business of Energy. It includes links to and summaries of all the research that I publish online during the week. That way, you don't have to rely on social media algorithms to surface all the stuff that I've been sharing. I also include an energy related anecdote, insider observation that I don't share anywhere else. So if you've seen all the stuff I've posted online, you'll still have something new to read in the newsletter. This weekend's newsletter, I'm going to be writing about Japan's very heavy investment in LNG. Bloomberg covered that's this week, and I have a few observations I want to make around the importance of LNG of Japan's LNG investments and why that's creating the consternation, the tension that it's creating, and what that might mean for the development of the energy transition from here. If you haven't signed up to receive that newsletter, you can hit the link in my profile. I'll almost certainly put one down below as well. In addition to the standard research that I share, I also have Foundations of Energy. That's the learning and development tool that I built and I publish on Substack. This week, I will write about ExxonMobil came up with a 2050 rather global outlook in terms of what the energy mix will look like in 2050. BP also came up with a 2050 outlook that they released about a month ago. I compare and contrast those two outlooks because we can start to see some interesting differences in how those two companies view the world, view the energy landscape, view the development of that landscape going forward. Some of those differences are what you might imagine. Some of them are not. I learned some myself as I dug through those two reports. So if you're interested in that kind of thing, check out the Foundations of Energy. That's over at Substack. As always, thanks so much for reading, watching, liking, commenting. I appreciate all of it. I hope you had a fantastic week, and we will talk soon.